very grateful that you have been able to make it and join us. So let me just begin by introducing my colleagues. To my right, we have Mr. Ajay Khurana, Executive Director, who is in charge of retail banking. To his right, Mr. Lalit Tyagi, who looks after international business and most of our platform functions, including risk and compliance. To my left, Mr. Devda Chand, our Executive Director in charge of corporate and treasury and our Managing Director designate. And to his left, we have Joydeep Datta Roy, who looks after digital, also looks after IT, and also all our subsidiaries. And to my extreme left, we have Ian D'Souza, our Chief Financial Officer. So I'll just take maybe about 7 or 10 minutes max of your time, and then we'll open it to questions. Might come there. All right, thank you.
Show the PPT, please.
This quarter, declare the numbers in terms of business in advance and immediately after the quarter ended. So you would be familiar with them, but just to refresh your memory and to bring both the business numbers and the margins in context, I'll start with the business numbers that you see before you. So we have been guiding that for us in order of priority, the most important is underwriting standards and credit quality, thereafter margins, and thereafter growth. We had also guided at the beginning of the year that we believe in this year it should be possible to not only have a margin but also to get growth. So very pleased at the end of the year we have growth which is been good, better than our guidance and also better than the average for the industry. If you look at the advances in particular, they have grown very handsomely. The global advances have grown by 18.5%, and international has been an outstanding performer here, growing by 30%. But for those of you who have been following numbers in detail, you would recall that international had grown by 40% towards the middle of the year. It has come down a little bit, and we believe that trend should accelerate. The reason why the international book grew faster was that last year the opportunities of getting margins on corporate business were limited, so we grew international more. Going ahead next year, we would believe that international would grow broadly in line with the overall loan growth as we go ahead. What is equally gratifying for us is that in terms of the composition of growth, retail is the one which is the standout performer for us right through the year, growing by nearly 28% YOY over the full year. This is something which again has been a matter of deliberate strategy and a board mandate. We have been guiding that it would be our endeavor that if growth is X, we should make sure that our retail growth is about 1.5x and corporate 0.7x. As you will see in the numbers, that the numbers have panned out exactly on that basis, which has meant that progressively our balance sheet has become more retail oriented. This, I think, will de-risk the balance sheet as we go ahead also, because relatively speaking, the proportion of retail was low for us. The second part is even if you look at delinquencies, delinquencies have been the lowest in the retail segment for a long time. So this also means that if you were to look ahead, the asset quality should also improve as the composition of the growth changes. If you look at retail growth, again it is very diversified and each of the segments is growing pretty fast. That's again a matter of much satisfaction because we recognize that there are cycles. There will be times when some segment grows fast, but if you have all cylinders firing, you can be much more sanguine in terms of the fact that the growth is sustainable. So the slowest growing segment really is mortgages and home loans, which is again at 18% plus. And some areas like retail personal loans continue to grow extremely fast at 100%. That's at a relatively low base, but nevertheless, it has now become a size where it is contributing to margins very handsomely. If you look at the last quadrant, you will find that the growth in disbursements is even quicker, which again augurs well for the longevity of this growth. Next slide. Deposits has been a challenge for all of us this year, and here again the bank actually has outperformed the market by a significant margin, and equally importantly, the difference between deposit growth and loan growth, which for some banks has been a proportion of 2:1, is marginal for us. Deposits have grown by 15% against loan growth of about 19%, which means that if you look at the CD ratio at the end of the year, and the material CD ratio is the domestic CD ratio, because that is driven largely by deposits as a resource unlike international business where you actually raise MTNs and the like to fund the business. So the domestic CD ratio, even at the end of this year, is just about 75%, which means there's plenty of headroom for us to grow our loans without being constrained by deposits in any manner whatsoever. The international growth again has been funded almost on a one-to-one basis by deposits, which is remarkable. So you'll find that the CD ratio international has remained constant through this period. Domestic CASA again has grown by about 8%, which might be system or a little better than that. And term deposit growth has been faster, which is completely understandable when rates are picking up, because the differential between the savings rate, which is sub 3%, and the term deposit rates, which move up to 7.5%, 8%, is very substantial. And even lazy people like me might want to move their deposit from savings bank to term deposits. Next slide. So if you were to now compare our growth with industry, just in terms of numbers, what we have done is we have compiled the results of all the banks which had declared the results up to yesterday. And you find that we have outperformed the industry significantly. Again, you might recall guidance that it is our endeavor to make sure that we grow at industry plus. We don't target a particular number in terms of growth, but we are very, very keen that we protect our market share, and we have again outgrown the industry by a substantial margin. And when it comes to scheduled commercial banks, so the middle slide is the top 8 banks, public and private sector. The slide on the side is all banks. So I think the outperformance is significant there. Yeah, next. So the good part again is that we have been able to protect and improve our margins along with growth. As I told you, for us in order of priority, margins come first, growth comes later, and therefore again the margins are something which actually have improved. In some ways, the margins have been a bit of a surprise for me. You might recall when we had met at the end of the last quarter, my own sense was that now that the lag between the deposit pricing and the loan pricing is gone, we should find again margins stabilizing. But we actually have been surprised by the continued improvement this quarter also. While some banks actually have reported a sequential decline in margins, we have seen a very, very smart uptick in margins this quarter also. Move ahead. Yeah. So again, if you see the margins compared to industry, just to put the numbers in stark relief. So our margins sequentially have grown by 16 basis points as compared by industry. Again, top 8 banks, private and public sector, by 4 basis points. Similarly, the NII expansion is also substantially faster as compared to our peer group. Yeah. This is the quarterly profitability. So as a consequence of the smart growth and also the margin improvement, profitability again has shown a very sharp improvement. And for the quarter, you will find that in all operating metrics, whether it is net interest income, operating profit, profit before tax, profit after tax, we actually have had a record quarter by some margins. The profit after tax is about 4,800 crores, which again, given that we are exiting the year, gives us some comfort in terms of how the next year might be for us. And the operating profit also, that is up significantly, and even again, as we'll see, YOY by 20%. So the uptick that we see is derived from very, very strong growth and operating metrics. This is the annual profitability figure. So we have ended up with a net interest income growth of which is only 28%, operating profit as I mentioned 20%, and PBT and PAT again are up by a very handsome margin, profit after tax by nearly 94% at 14,000 crores, which for us by a very, very long margin is the best we have ever done. And as we'll see, in terms of ROA and ROE, it translates into very significant numbers. Yeah, next. So if you again were to compare us with the industry, so here again, you will find that in almost every metrics, we are outperforming the industry, including again operating expenses. I think this is something which is very significant for us. I think we are one bank which have not grown our physical footprint. In fact, it is substantially shrunk as compared to 3 years back. Our manpower numbers are also very well contained, which is why consistently the growth in our operating expenses has been much lower as compared to the industry. And this is still, you might say, a bit of an overstatement in terms of the operating expenses, overstated on 2 accounts. One is that, of course, the wage revision, which happens once in 4 or 5 years, for public sector banks. This quarter was the first quarter where it was fully reflected, and then also again there are some other one-off expenses. But even if we take this, I think we are pretty successful in making sure that even as we grow better in the industry in terms of revenues, the growth in expenses is much lower as compared to industry. The last piece, if you can just go back to the last slide, is of course the credit cost, which is the single biggest determinant in terms of the performance of a bank. We have been guiding for a credit cost of about 1%. Again, we have surprised ourselves again very pleasantly, and credit cost has come out at about 0.5%. So, and we have been guiding that while there were some residual challenges when it came to the MSME sector, but the benign corporate cycle would far outweigh those challenges, and that is what has been borne out. In our view, again, the corporate credit cycle continues to be very, very favorable. In fact, if you were to look at our composition of balance sheet, corporate along with international business is about 60% of the balance sheet, and that is where we are seeing credit costs as virtually negligible. So I think this improvement that we see, we believe is sustainable as we move ahead. Yeah. This is the asset quality number, where again we have seen consistent improvement right through the cycle, even during COVID. Now we have reached a stage where, because of the fact that credit cost is low, we are finding that NPAs have almost stopped growing, which means that even if you were to ignore any write-offs, the recoveries we are getting are more than the slippages which are there. Slippages have come down to about 1%. They used to be as high as 3%. So I think in every way, whether you look at gross NPAs, net NPAs, credit costs, slippages, in all metrics, the quality of the book is absolutely first rate. There's an additional metric which is there, which I think we'll discuss again in terms of how the numbers look like when it comes to the SMAs, which would again tell us that not only are we currently in a very good place, but even if we can peer into the future, as far as we see, we seem to again be in a good place in terms of future trends. Yeah. So this is again what I was alluding to. You might remember that in terms of the acrylic numbers, there used to be. That's it. So good. Thank you very much. I think they have left the thank you slide. So let me say thank you again. Thank you.
I'm Joel Bello. I work for the Economic Times. Your credit costs have come down. Slippages were expected to come down. I think you mentioned in your presentation that it's sustainable because of your large corporate and international book. Can you please elaborate on what is the expectation going forward? Is this 0.5% really sustainable?
So I think the point was that if you see where we are in the credit cycle and where is improvement coming from, and for most banks the corporate cycle is benign. For our international business, if you look at last 2-3 quarters, there are virtually no slippages. So since in terms of our composition and balance sheet as compared to some others, it was, you might say, a handicap when the corporate cycle was adverse to have a balance sheet which was 60% corporate and international. Today it's an advantage. So therefore it becomes a competitive advantage for us. We're not saying this is what we want to be forever. We do recognize that cycles turn, and in the long term it makes much more sense for us to have a more retail oriented balance sheet. In fact, the composition, if you look at the balance sheet and look at the detailed presentation, you'll find that the percentage of retail has gone up by 2 percentage points. But given where we stand in the cycle today, it is something that gives us enormous comfort and support when we look at it at the medium term, that we can actually sustain this kind of credit cost or this kind of slippage ratios.
In the next 6-8 months, do you think it will be at 0.5%? Do you think that there could be some increase in the cost?
So credit costs we are as of now guiding, and we believe that should be the long-term structural rate for the bank. Okay. Is that credit cost should be sub 1%. Okay. Right? That is what we are guiding, and we believe that's something which we can deliver.
Just a sense on your recoveries, because the drop in provisions, increase in credit costs has played a very important part in the results today, besides of course the loan growth. So just a sense on your recoveries, your upgrades, and what's the trend that you're seeing, if you can drill down a little bit on that.
Prasad?
This year the recovery is 10,000 crores. in TW recovery is 3,200 crores. Our upgradation is more than the previous year, and we are expecting that, one is overall our target is that our recovery and upgradation should be more than the slippages. So if slippages are going to be controlled, this is of course it will be a lesser one, but still it will be more than that. This is what is our overall target.
What was it, sir, in the last quarter or something?
Last quarter recovery.
Recovery and versus slippages. Recovery versus slippages.
Overall slippages. The 2,800 was the recovery and 2,100 is slippages.